Today, I want to address a common question about IULs. Does the insurance company keep your cash value when you pass away? I've seen this question across a number of YouTube comment sections as well as Reddit threads. In fact, I've heard some answers which are completely wrong. I'm not sure if some financial professionals are trying to push other products they sell or if they just don't know. But by the end of this video, you will have the right answer. Now, whether the cash value is added on top of the death benefit or not, it depends on how your policy is set up. So when an agent set up an IUL policy, one of the key decisions they make is the death benefit option. The two most common options are increasing death benefit and level death benefit. Understanding the difference between these two is critical. But before we dive into that, let me explain one important term that will help tie everything together. Now, imagine you've saved $20,000 and you want to buy a house worth $200,000. You will still owe $180,000, which is the amount of mortgage you will need. So that $180,000 is the risk the bank is taking on. Now, while the bank can sell the house if needed, they still assume some level of risk. That's why they will usually require you to have a homeowner's insurance to protect their investment in case something happens to the house. A similar concept exists in life insurance, known as the net amount at risk. This is simply the difference between the death benefit and the cash value. As your cash value grows, the insurance company takes on less risk. So let's compare two people, Fred and James, both with $100,000 death benefit in their IUL policies. So Fred has $25,000 in cash value while James has only $10,000. Now, even though both have the same $100,000 death benefit, the risk to the insurance company is different. If they were to pass away today, the insurance company would have to come out of pocket $75,000 for Fred and $90,000 for James. So the risk the insurance company faces isn't based on just the death benefit amount. It also depends on how much cash value is in the policy. The net amount at risk is lower for Fred because he has more cash value. Because of this, the cost of insurance is based on the net amount at risk. The higher the net amount, the higher the insurance cost. For example, if somebody wants $1 million in death benefit, their insurance cost will be generally higher than someone with a $500,000 death benefit, assuming everything else is the same. But let's say the person with the $1 million death benefit has $700,000 in cash value, while the person with the $500,000 death benefit only has $50,000 in cash value. In this case, the net amount at risk for the first person is actually lower than the second person. That's $300,000 versus $450,000. So even though the first person has a higher death benefit, their insurance cost will be lower, again, assuming everything else is the same. Remember, the cost of insurance is directly related to the net amount at risk. I hope that makes sense. If not, put some questions in the comment section. With this understanding of net amount at risk, let us look at how increasing death benefit and level death benefit differ, starting with increasing death benefit. Let's say you set up an IUL policy with an initial death benefit of $100,000 and you choose increasing death benefit option. Over time, your cash value grows to $30,000. When you pass away, your beneficiary will receive both the initial death benefit of $100,000 plus the cash value of $30,000, making it a total of $130,000. This is straightforward and is what most people expect. However, it's important to understand that with increasing death benefit option, the net amount at risk will always be the initial death benefit, which is $100,000 in this case, What does this mean? Well, it means that when the insurance company calculates the cost of insurance each year, it will be based on the initial $100,000 death benefit. The cash value doesn't reduce the risk to the insurance company because it's paid out in addition to the $100,000 death benefit. So the insurance company is always liable for the full $100,000, and that's why the cost of insurance is calculated based on this amount and not reduced by the cash value. Now let's look at level death benefit. Let's say you set up a policy with an initial death benefit, again, same $100,000, but this time you chose level death benefit option. With a level death benefit, the insurance company will pay out only the death benefit amount. This can be confusing because it might seem like your cash value is being taken away, but that's not the case. Let me explain. In the level death benefit policy, your cash value helps reduce the risk for the insurance company. Unlike the increasing death benefit option, where the risk is always the full $100,000, here the risk decreases as your cash value grows. For example, if your cash value grows to $20,000, the net amount at risk to the insurance company is reduced to $80,000. This means the cost of insurance is calculated based on only $80,000 instead of $100,000. If your cash value grows to $30,000, the net amount at risk drops to $70,000, and the cost of insurance is calculated based on only $70,000. The key point is that as your cash value grows, the net amount at risk decreases, which means the cost of insurance will also decrease, since the cost of insurance is directly tied to the net amount at risk. Now, which option is best for you? It really depends on your goals. If your main focus is building cash value, which is what most of my clients want, then increasing death benefit option is ideal because it allows you to contribute more cash over time. Once you stop paying money into your policy, you can then switch to a level death benefit option, which lowers the cost of insurance over time and makes the policy more efficient in the long run. I'll create a separate video to dive deeper into the numbers. If you want both the cash value and the initial death benefit, then increasing death benefit option is the only choice. If you found this video helpful, please support this channel by subscribing, give this video a thumbs up, and hit the bell icon so you don't miss any future content. And if you have any questions or thoughts, drop them in the comment section below. I'd love to hear back from you. Thank you so much for watching. I'm Gilbert, and I'll see you in the next video. Bye.